Welcome back to the What's Your One More podcast. I'm joined again with one of my standing co-hosts, Mr. Alex Stewart with the Market Distillery. Thanks for being on the show as always.
Of course.
I feel like we got so many important topics that we have to cover here. And, you know, as new guidelines, as new headlines, you know, for whatever it is, inflation, you know, GDP, it doesn't matter. This is more in the mortgage world. And this is where I like to kind of take a stand against like consumers and really make sure they understand some of the facts that are going on out there. And the reality is we got people in our industry that aren't really good readers. You know, they just jump the gun and throw something out there on social media because, you know, they can, right? And at the same time, it's just not it's not conducive for the borrowers or even for real estate agents because you start fielding kind of some calls that just make you scratch your head and like, where did you hear that?
Right.
And kind of today is a topic where we want to tackle, if you may. You know, FHA. How many times in the last 48 hours have I heard the question, hey, when are you guys going to start releasing the FHA 40-year mortgage? And I kind of have to chuckle and laugh when I hear that because I'm like, what in the hell are you talking about?
Right.
And, you know, did I miss something? I mean, I read all the releases that come out and, you know, this is one of those topics. I mean, how many times have you seen this?
Yeah, I mean, I saw it first on social media and it made me search it. And I think maybe I caught it late enough that when I searched it, I was able to actually see the real article. But being in the industry, we obviously knew that if something was going to get released like this, you get a heads up. It's not like it's just out. And I think it speaks to the, you know, I feel like our theme of this show in a lot of good ways is getting below the headlines.
Yeah.
And this is a perfect example where headlines are out. The people in real estate are like sharks waiting for chum to be thrown in the water
and
when
that
it
chum
comes
being
to
some sort of
good news.
Yeah, exactly.
And so I think what happens is they see a headline and they knee jerk and immediately go to try to promote this and put it out there. And it's like the telephone game.
Yeah, you want to be the race. You want to be the first. It's a race to be
Correct.
first online to put it out there as if like you created it, right?
And
but
at the
there's a
end of the
lot to
day,
be said just to sit back and digest something. Be a little knowledgeable about what you're putting out there, right?
Right, exactly.
So, I mean, let's talk about this. So, for those listening, we'll get right to that. There is no 40-year amateurization new mortgage for FHA, regardless of what you're reading, regardless of what your lending partner's telling you, regardless of, you know, what customers are asking you. Just set the record straight. There is no 40-year, you know, amateurization for an FHA government loan, meaning we're not going to create more affordability. We're not going to allow buyers now to go buy a home on a 40-year term. Like that is not the case, correct?
Yeah, exactly.
Yeah,
the only 40-year loan that you can get out there is going to be through what's typically not a normal mortgage that people would get, and the rate on that's going to be higher, and it's going to have some other stuff.
But what you are hearing about the FHA and where the water's being clouded, if you may, is this is a modification, meaning that if you're a current person that's holding an FHA mortgage, you start the eligibility process.
Right.
Outside of that, there's some other things that have to happen. But if you're a new buyer, there's no 40-year term in FHA. And if you're a real estate agent and for whatever reason your lender or the social media has come across and says there is, stop reading that. You know, I'm looking at a social media right now from a very, very popular national, you know, mortgage person. It says breaking news, lower mortgage payments. It has like lightning bolts and, you know, has all kinds of exclamation points. And it shows a 30-year mortgage versus a 40-year mortgage on $400,000, $450,000, $500,000, and then the savings, monthly savings on the side. That's extremely misleading. Right. And not only that, when you go to read it, it just says, hey, lots of news articles stating FHA is going to release a 40-year mortgage term, but not a lot of details yet. Can't wait to see what this does for the purchase market. Well, I can tell you what it's not going to do for the purchase market. It's not going to happen, and that's a misleading headline.
Right.
And you know, and because there's no regulation around a social media post such as that, it deems, especially with this person's clout, it deems to be real, right? And you see this liked, this shared. I mean, this had over 360 likes in less than a day, and it was shared multiple times. So that's how rumors get started, right?
Sure.
That's the rumor biz. But if you know what a modification is, hey, you can just turn this podcast off and, you know, go about your day. But if you don't, we'll break it down for you and kind of share what it is. But the reality is there is no 40-year term. It's a 40-year modification plan. So if you're currently an FHA holder of a loan, Alex, let's say you own an FHA loan and you want to get this modified, what would happen is first you would have to call your servicer, not a mortgage lender. So if your loan's being serviced by Bank A, you have to call Bank A and say, hey, Bank A, I would like to get my loan modified to a 40-year amortization schedule for an FHA loan. And that servicer is going to look at you and say, okay, what's changed in your world for this to happen? Right. Because you got to think about this as a servicer, and we've talked about this numerous times. My job's to limit my risk for the investor. The last thing I want to do is stretch your mortgage out over 40 years and increase my risk. Wouldn't you agree?
Right.
Because I'm stretching your payments and your terms out over 40 years, right?
Well, and it's now a totally different investment than what sort of the deal was with the investor. So they're going to value this completely different.
Yeah. And the term modification comes from modifying the original agreed note between the lender and the buyer.
This is for duress. This is, I can't pay my bills. I need help. What's the first step? It's to try to go get, instead of a foreclosure or short sale or anything like that, it's, can I just get some different terms on my loan so that I can pay the note,
and so when we talk about this, the whole idea is exactly that. We've talked about how the economy's having issues right now. Right. We've talked about certain markets are feeling it more than others. So, I mean, if you think about an FHA loan, typically people that are putting less money down to obtain an FHA loan are usually either your first-time home buyers or people that don't have enough money saved up to put the traditional 20% down.
Sure.
So one of the alternatives is FHA loan. Doesn't mean you have bad credit. It doesn't mean you're under duress. It just means that you may not have the affordability to put 20% down to avoid PMI. And the cheaper alternative to that, traditionally speaking, is FHA loans. Mm-hmm. So that's the pool of people that we're talking about that have an FHA loan right now. Well, as the market starts to deteriorate, and we're starting to see some signs of that, via the job reports, there's a chance that this pool feels that impact quicker than maybe someone that has more equity in the home. And that's just statistics speaking, not necessarily anything other than that, right? Trends show us that, and we can look at the trends over the last 20 years. So what FHA is doing, just like they did in 2009, by the way, they did this in 2009, this is not new. They said, hey, in order to limit our potential risk that we see happening, we are going to offer a modification and incentivize servicers to do these modifications, which means I'm taking your current balance. Let's say you have an FHA loan that you acquired over the course of, last year before, it doesn't matter as long as it's an FHA loan. Let's say the balance today that you've paid it down is $350,000. FHA is now going to allow that servicer to take that $350,000 if you meet the modification requirements, and we'll talk about those here in a minute. And now you can re-amateurize that for 40 years out. It should significantly lower your payment.
Well, especially if you've had your loan for any amount of time.
Yes.
The people that are not going to get the most benefit out of this would be the people that just bought.
Yeah.
Because they've still got 30 years on their loan.
And now we're just adding extra 10.
We're just adding 10, so it's not that big of a deal. Yeah. But if you only had 15 years left on your loan and you had another 40 on a much lower number, that spreads it out.
Even if you had 25 and you add 15 to it, or even 27, you're taking 10 years off. So on that example that I was talking about, on a $400,000 loan, that saves you $200 a month. That's a lot of money. That's net savings, right? And so some other things that you'd spoke about that could have caused this modification to be an issue is around the country is taxes on these properties have gone up. Depending on what state you live in, you may have seen a significant jump in your property taxes, which could cause your household to be upside down in this payment. And that's a problem. Homeowners insurance, depending on where you live in America, homeowners insurance has gone crazy as far as sometimes 2-3 times multiples from what it was a year before or the year before that. So that's caused your payment to go up dramatically. So those are some things that you can make an argument for that will help on this modification side. The other argument is if you're a 2-income household and you lose an income, right? This could be a big help to your family.
Right. Or divorce, or
this could help you keep your house, right?
Right.
Because if you think about FHA, their number one goal is to keep homeowners. Sure. It's not to get rid of homeowners, right? The Federal Housing Administration was put in place to help people buy homes with lower down payments. And in some case, down payment assistance loans, which are always on the backbone of FHA as well. So their goal is to keep you in the house. The last thing FHA wants to do is see someone have a foreclosure of an FHA loan. Matter of fact, one of the hardest loans to foreclosure on is an FHA loan. Sure. To unravel that loan, because they will give you so many chances to make that right before they foreclose on it. It's not like a traditional loan where foreclosure process starts after like 60 or 90 days of delinquency. FHA will work with you on this, and it's a testament to what type of system they've put in place there for their homeownership.
Does getting a modification hurt your credit?
Yeah, it could. It absolutely will. And it all depends on how the servicer reports it. Now, if they're just re-amateurizing it, right, and they're stretching out over 40 years, you're going to see a new trade line show up that says, hey, listen, loan modification 40 years. That doesn't necessarily hurt. It doesn't necessarily stop you from borrowing in the future. Now, if they take anything off the balance, if there's a shortfall in what you owe, that's typically going to be called a short sale, which we're not seeing hardly any of, if any at all right now, because there's so many equity positions. That anytime you don't pay the full debt that you owe, that's when you start to have credit dings, right? But in this case, you're paying it back. They're just giving you additional time to do it.
It's almost like forbearance a little bit, right? From the standpoint of...
The only difference is forbearance,
That's a cutting the payment off completely and just tacking it on, and then you'll pick it back up later.
That's right. Yeah, that's exactly what that is. But in this modification process, you're literally just extending the term over the new 40 years versus finishing the term that you're on.
Right.
So, you know, if you paid this down and you have 27 years remaining, you just picked up an extra 13 years.
Right.
That's what you're going to do at this point
gotcha.
in hopes of getting that mortgage payment in a more affordable stance. And I would imagine, based on what I was reading earlier, I would imagine that you're going to get the new FHA premiums.
Mm-hmm.
And what I mean by that for our audience is that the monthly mortgage insurance premium, which many of us call PMI, but on the FHA world, it's called monthly insurance premium, same concept, has been drastically lowered, over the course of the last 2 months. So you're probably inherently going to get a drop in that as well, which is another big win for the modification side of things.
Interesting.
So, you know, if you are a prospective homeowner that has an FHA loan, and if you're a real estate agent that has borrowers that you know that are still in those homes and they meet one of these qualifications we're about to talk about, it might not be a bad idea to see if it wants to help them out, because, you know, it doesn't hurt you to do that as long as you meet one of the qualifications. And more than likely, this is a mod to help, not a mod to benefit.
Right.
That's real important. I mean, I think when you think of the term modification, it's important to understand that modifications are to help, not to benefit.
Right.
Big difference here. So let's talk about modification. Life-altering circumstance change. That's typically the terminology that's used around that. And we know from the past how they identify that, right? Loss of job.
Right.
Loss of household income, whether it's defined through a loss of job, a divorce, death in the family.
Right.
I mean, all of these things can be proven.
Illness.
Right? Something that you can document versus going, oh yeah, our income went down. Well, you've got to be able to document that, right? So if you can give a pay stub showing your incomes because you switched jobs and went down, well, this is going to give you a stance to get that done. If you lost your job, obviously, and you're filing unemployment, that's going to give you a stance to get that done. If you are in a divorce situation, right? If you have divorce papers, that's going to give you a stance to get that done. Now, if you're separated, that might not work. Because it's harder to prove. But, you know, if you're receiving child support and you're no longer receiving that anymore, that's going to be an opportunity in which you can talk about that. So there's a lot of life-altering situations. You mentioned earlier, illness, sickness, something's, you know, unfortunate like that, you know, that's a long-term disability or long-term illness that you can document. That's going to give you an opportunity to talk to the servicer about getting that loan modified.
Yep.
But what I really want to stress home here is that this has nothing to do with Charlie, our producer, wanting to buy a home and going to a lender and saying, I can't wait to get my hands on this 40-year, because that's not what this is.
Do you think that would happen in the future, though?
Well, I mean, it's happened once already in 2006. We saw the 40-year AMs come to the table from Fannie Mae and Freddie Mac from the agencies. That was a popular trend. They do bump the rate a little bit, but that was there. And I don't think that was there necessarily to stretch the affordability as much as it was to well, I guess it was there to help the affordability. Anyway,
what else would it be there for?
Yeah,
right?
that's what it would be there for. But I was kind of thinking something completely different there. But I guess that's exactly why it was there, because home prices rose so quickly, so much in 2005 that the 40-year term was one of the only ways you could get the DTI down to get those Fannie Mae approvals or those automated approvals through the system, right?
Yeah.
It's not that the borrower couldn't necessarily afford it because you had to prove your income on those types of loans. It's just trying to get that DTI down to where Fannie Mae could go ahead and run it through the automated system. So
yeah, it is interesting just looking up some generic numbers about 40-year versus 30-year, because I think the general assumption is a 40-year is going to be drastically cheaper than a 30-year. And the hard part is at the same interest rate, you're typically only talking about $100, maybe $200, depending on the price point. So it's not necessarily a total, I'm going to take a $1,200 payment and make it an $800 payment, or a $2,000 payment and make it a $1,600 payment necessarily. But the interest that you pay is about 30% more. So
yes,
it is.
There's a bump in rate for it.
Huge cost.
And why would there be a bump in rate?
But because now it's a riskier thing.
Yeah, of course.
It's one of those things where there's more things that could go on during that time frame.
We're making an agreement for much longer.
It's going to take you longer to get your money back, all those things.
Yeah, we're making an agreement for much longer circumstance than what we had agreed to do prior to. So you're going to see, okay, that makes sense.
Yep.
You know, you're going to put this out there. I'm going to extend a longer term loan. I'm going to get paid a little bit more interest risk.
Are there any other products that existed before 2008 that you think could come back out?
Yeah, that's a great question. I was actually looking that up on the phone. Here's what I was doing when you were talking there. But yeah, there is. And as I get into that, one thing I wanted to make a point about that I think I forgot there in our discussion is that FHA's default rate. Now, default doesn't mean foreclosure. But FHA's
just means you're behind in payments, right?
It means you're behind in payments, right? And when I talked about FHA being able to see the data, that's what I was referring to. Their default rate has jumped significantly, meaning that they have people behind 30 days or more late on their mortgage payment to double digits. So it's over 10%. Out of all the loans in the United States, No one's even close to that. VA, USDA, conventional, not even close. QMs, not even close. But FHA is. And that's because traditionally speaking, trends show as we get closer to a recession, the FHA loan feels the impact before other loans. Yep. And so as basically a stop loss or as an injection of help into the system, FHA has said, hey, time out. We've seen this in the past, and we're going to be aggressive on the move here, and we're going to allow for the 40-year modification now because we believe we can save a lot of these payments that are 30 days late coming back if we can just get that out there. Oh, no, by the way, if you're late on a payment, part of the modification is to kind of get rid of that lateness.
Sure.
That's part of it, right? So that helps out dramatically as well. So I think this is a very smart move. It's a proactive move by FHA, which is something that they've always been very aggressive in doing, and we're starting to see it do again. It just kind of gets underneath my skin when it's promoted as something that it's not. And we have loose lips originators running around just posting and going that are cloudying the water or something that just doesn't need to be there.
Yeah.
And so we spend a portion of our day, educating people on something that someone just took the time to read would have really made a difference here.
Yeah. Black Knight puts out a report that goes over delinquencies and things like that. So just for reference, our current delinquency rate in America is 3.45% on mortgages, right?
Which, by the way, is relatively in line with a national trend.
Well, so it's a smidge off a record low, and if they go back and say what was the 2000 to 2005 average, that was 4.5. So we're about 1% below on delinquency. So from this standpoint, there's no issue with delinquency overall. But then when you go in and, like you were speaking about, and look at the different types of loans, FHA is sitting at around 10% delinquent.
Yeah, it's double digits. It's significant.
Correct. So the delinquency rate is all in FHA.
Correct. Compared
to VA, compared to conventional, and even compared to a jumbo loan.
Well, and the reason I want to speak to that is from a military standpoint, when you look at VAs, they're typically 100%, right?
Sure.
But military people are typically very militant.
Yep.
They are used to following rules.
Well, and they get guaranteed income. That's the other thing.
Income,
they're not getting laid off.
Exactly. And they're told, even by their COs, make your mortgage payment. Like It's literally an order of command inside the military, right? And so they do it. And you look at conventional loans, for the most part, you're going to have some equity positions in there, much more than 3%, right? And then when you take a look at jumbo, it's a minimum 15%, right? So when you look at the delinquency rate, all of those people, quote unquote, have skin in the game from a conventional jumbo standpoint. And then we just discussed military consistent income and then also command orders to make that. But when you look at FHA, less skin in the game. And that's usually typically the homes that you see have a higher delinquency rate. Again, delinquency doesn't mean foreclosure. I want to stress that.
Yeah, I think I get the equity argument. I think, though, it is that type of borrower does typically have a lower credit score. That type of borrower does typically have a higher debt-to-income ratio. And
always,
so to me, rather than the equity being the point, those are the two that I go to say that's probably the big why is there delinquency?
Yeah,
well, they probably had issues
to begin with,
right.
Right. If you're looking
now,
if you're using that balloon analogy, right? Balloon. This isn't a balloon that's comfortably filled. This is a balloon that is stretched to capacity, which is typically why it got an FHA loan to begin with. There's all the air has been pumped into this thing.
Now we will see if I had to project out, I do think we will see a difference in this because now when you have someone with good credit and a good job, and you price out and say, what's your rate for FHA? What's your rate for conventional?
Correct.
What's your monthly payment for conventional? What's your monthly payment for FHA? And we're talking 3% versus 3.5% down payment. So these are very similar loans. Yeah. The numbers right now are significantly better FHA. So there are plenty of people choosing to get an FHA loan.
That's correct.
Because it's a better financial position.
Well, that just recently happened. That's very recent in the last 9 days. Two critical things happened there. One, the rate change has happened. Right. We've seen conventional rates go up drastically. FHA not as drastically, more favorable rate. And then number two is that MIP and the monthly payment, which is also, people call it PMI, but the monthly insurance premium has been cut drastically, and that's been the win here. So to your point, we're starting to see more borrowers that could put could put 5% down or saying, wait a minute, I've got higher credit score, I make good income, but it's actually cheaper and my payment's cheaper to do this through FHA. This also happened in 2009, 2010, Alex, exact same thing. What did FHA do? They reduced the premium. They're following a playbook. They did the same thing in 2009.
So what happened after that? I want to know the next chapter of the story.
Next chapter of the story is that FHA literally filled up their entire premium. That premium they're collecting is a default insurance premium, right? And as they fill that to capacity, all of a sudden we need to detour FHA business. We don't need this much anymore. Some of these buyers, as we run the algorithms, we start discovering lower DTIs, great credit, basically are people that normally wouldn't jump right into that FHA loan are doing it because we've incentivized them to do it.
Right.
So now they de-incentivize them by raising that premium back up. And so FHA FHA is used for creating that American dream, if you may, for a homeowner to be a homeowner at all angles, right? But what they don't want to do is make it a center to where you're getting, you qualify for another loan, but you're choosing this one because we've made it so great. And so our pool starts to become a little too filled, and we've got to start to turn the spigot off here because we don't need all that business coming through here.
Do you think Fannie Mae and Freddie Mac would get more aggressive and help? So rather than make FHA more expensive, do you think Fannie Mae and Freddie Mac would make their product less expensive to compete?
Well, what they'll do is they'll start pulling back on some of these LLPAs. They put out these loan level price adjustments. That's one. And then two, they might make it more attractive for that investor / second home to come back into the market that they've kind of pushed out.
Okay, so loan level price, that's like if you have a debt to income ratio that's higher on average, your rate is actually going to be higher because of that.
Hey, why do you think Fannie pulled it back? It initially was supposed to take place in March, and Fannie Mae and Freddie Mac pulled it back. It's not ironic they pulled it back right the same time that two things happened. Number one, FHA made the announcement to reduce the PMI or the MIP, which they did. And number two, rates jumped when that announcement came out. And as rates jumped, as we know, started beginning of March around 6.73. By the end of March, they were at 6.23 or 6.32. Well, FHA was still a lot lower than that. And so this is not ironic. So Fannie, it's exactly what they're doing. So, cool. So they push that back to August. They're gonna punt and see what happens between now and August, and they may not even bring it back out. You just don't know what that's gonna look like. I'm sure there's other reasons, but from the observation deck, that's the first thing I see.
Yep.
On that. So the other thing you said was, hey, what other things were available in 08, 09, 06, 07 that you could see coming back? What's interesting about the agencies is they have a slew of products sitting on the wall. Like if I'm looking behind you here, there's a wall with shelves on it, right? Each one of those books, each one of those vases or pots, that's a product, right? And Fannie has a slew of those. And some of the ones that we saw that were really popular that did help with affordability as interest rates got into the mid sixes, upper sixes during that 05, 06 era was a Fannie Mae, Freddie Mac interest-only product. Now, for a lot of people, when they hear interest-only, like, oh, God, it's awful. It's a I still owe product, right? The ISO, I still owe. Cool. And the reason it's ISO is because you're making an interest-only payment. You're not making a principal payment, so your balance is never going down, right?
But your payment's less.
Your payment's less. But the way Fannie and Freddie did it was they did it from a responsibility factor of saying, hey, listen, we're going to offer you a 10-year interest-only, 20-year fully amortized loan, meaning for the first 10 years, you have the choice to make interest-only payment. You can pay down the principal as much as you want. Most people didn't. But if you did, you're paying it down. And then at that 20-year term, it's a full AM on that interest rate, remains the same the entire time, but a full 20-year AM. They also had a 1030, that one with that 40-year AM we were talking about. They also had a 1515. So they had a lot of different product options sitting on that shelf to help create affordability. I think Fannie's saying, hey, listen, we don't want to roll those out again in fear that two things would happen. We're already at some of the highest levels of real estate we've already seen. Yeah. Do we want to add more pressure to the market? Because we know it's going to happen. If they roll that product out, sellers are going to go, ooh, buyers are going to go, and they're going to jump in and buy. Prices are going to go up, right? If we naturally let the rates come back down, that's going to happen anyways, but that will be on a more natural basis than accelerating it. And I think Fannie and Freddie are super smart, FHFA smart, that's the agency that controls those, sitting back and saying, hey, listen, now's not the time for this product. I do sense had rates got in the sevens and maintained a 7.5 and got even higher to stimulate the housing market, I fully anticipated those products coming out. We may still see them, but in a market where we are right now, I don't see those coming out. But they are available, and they can make their way back. And you ask, how do they make their way back? Well, there has to be a buyer for those loans, right? There has to be an appetite for those loans. And with rates being the way they are right now, there's not a secondary market that's ready to buy those loans at this current position that we're in. It's not so much about Fannie releasing the product as much as it is a buyer for the product. And that's real important. That gets misconstrued a lot, but that's really how that.
And is a buyer for the product typically another bank, or who buys these?
I
would have thought Fannie Mae was the buyer.
Well, you got to have a pool, right? You got to be able to put them in mortgage-backed securities and go securitize them on the secondary market. So, the investor is wide range. I mean, you buy a hedge fund for your 401k. That hedge fund has mortgage-backed securities sitting in there. You just don't see them, but they're buying mortgage-backed securities. So there has to be buyers from all ranges on there to buy those and bid up those loans. And if you're not going to bid up that product because it's too risky or you don't see the valuation in it, it's not worth even putting out there.
Yeah, the one thing I do see when we sort of look at this conversation, take a step back, that is really important for home buyers, home sellers, realtors, everybody in real estate, there is a whole lot put in place to protect home values and to keep them from just plummeting.
That's a great point. Yeah.
And I heard this term. It has an upward bias. This is what that means is home prices. If anyone ever says, "Hey, home prices always go up," that's not true. We know that always is and nevers are never a good phrase, but it has a tendency to always go up, and that's because there's a whole lot built on values of homes staying positive, of increasing over time so that you have equity, so that when you go to sell, you're not having credit issues. It is a huge form of our GDP, right? All the economy is related to building houses and maintaining houses and selling houses. So if I'm a buyer or a seller and I'm hearing this, and I'm just concerned about house prices falling off a cliff, this tells me, though, look, it's not very likely. There's a, just like in the stock market, there's a plunge protection team that is going to keep things from getting too bad.
Exactly right. There's the stop alert.
They have a lot of tools that they will put out there.
Sure.
And ultimately, some of these tools have already made it out there and are going to continue to keep things going in an upward direction.
Yeah,
so.
No, 100%. I couldn't agree more. And that's such an important takeaway here is that real estate today, I would argue, is safer than real estate 15, 16, 17 years ago. And it's not even close. And the reason for that are these stop losses. The reason for that are the actual mechanics that are put in place on the lending side to verify everyone's information to the point to where it's not like, hey, there's this group that are falsely buying these homes inflated, and that's what's going to damage the market. And then there's this group that's having to have everything verified, and they're there protecting the market. It's everyone's being checks and balance to protect the market, which protects our values, right? So the threat to real estate right now is two things. Number one is obviously interest rates. I mean, we can't ignore that. If interest rates jump to 8%, there will be a threat to real estate. And that's because affordability will go beyond what people can afford. That's just that's a fact. And the other threat is lack of inventory.
Right.
I think you used the term the other day when we were kind of texting on some stuff. Inventory is throttling the market right now. And I think that was an excellent way of putting it because that is a challenge. Because as inventory goes down and it doesn't get backfilled, it's throttling the price points up. But as more inventory comes back onto the market, it's going to shift from a seller's market into a buyer's market, and prices traditionally stabilize, might even go backwards just a little until that appetite is fulfilled, right? But our projection is that appetite's not going to be fulfilled probably for another 3-4 years based on the build rate and based on the rate of which inventory is being supplied. And the third thing that I probably should mention too is that there are owners of homes, such as all three of us sitting in this podcast room right now, that refinanced or bought a home between the years of 2020 and late 2021, even early 22, that are sitting somewhere with a mortgage with a 2 handle or a 3 handle or maybe a 4. And those individuals are very slow to make the jump right now.
Sure.
And they're slow to list because if they're going to buy, they need to find a home that is better than what they currently have and come with an interest rate and a payment that's better than what they currently have. And that's going to be hard fulfilled. And that too is throttling the inventory.
Absolutely.
So, thank you for being on the show today. Always get a chance to sit down with you. It's always great. Learn so much. The bulk of this today, though, is to kind of just debunk this FHA situation. We got a lot of real estate agents that listen to this, and we've got a lot of customers that listen to it as well. So we wanted to make sure that everyone knew that was not an availability. And if you do want to take advantage of it, what the criteria is you had to match. And so appreciate that. Always appreciate your outlook on the market and insight on that as well. Alex, thanks for being on the show.
Thanks for having me.
For our listeners that want to learn more about Market Distillery, go ahead and tell them how to find out.
Sure. themarketdistillery.com or on Instagram at The Market Distillery. Best place to get to me.
Yeah. Love the stuff you guys are putting out there. Thanks for letting us be a part of it. Guys, if you like this show, you like what you're hearing, leave us some comments. We always love to kind of take those on during the show. 5-star review, write a comment specifically about this podcast you're listening to. Also, check us out on Spotify. Recently, they started releasing all the video with the podcast with interactive polls and questions. They've really stepped their game up over the course of the last 3 weeks. It's pretty special what they're doing over there. And then check us out on YouTube and subscribe to our channel as well. Thanks again for tuning in. Alex, as always, thanks for being on the show, brother.
Take care.
All right.
I got one more shot, I'm gonna make it. One more chance, I'm gonna take it. I meant it when I said it, now it's time for me to do it. I got one life to live, so I put my all into it, yeah.